Hi CMS, welcome to the session on CMA Part 1 Financial Planning, Performance and Analytics. In this session, we'll discuss about the accounts receivable factoring. When we have lots of receivables on our balance sheet, but we are running short of money, so is there any chance where we get financed? Yeah. So, using this accounts receivable, handing over to another company outside the organization, can we get any financial support? So we'll discuss in detail about this factoring. What is factoring? Okay, what is factoring? What are the different types of factoring we have? How we manage our receivables under with recourse, without recourse? What are the fees that are collected? And how much we can expect when we factor our receivables? Who bears the risk if our customers do not pay the amounts? This we'll discuss in detail. Okay, let's begin now with what is factoring. Factoring is nothing but the sale of accounts receivable to a third party. Third party is called factor. A factor can be a banker, factor can be a financial institution, factor can be anyone who gives us the financial support. So what we do here is we just hand over our financials, our receivables to a factor. Factor pays us cash. Factor will collect money from our customers. So this way we can improve our liquidity. Like say for example, we sold goods for 60 days credit. Now we are selling goods to our customer with 60 days credit and selling these receivables to a factor. So we're getting money back in 60 days. No, we are getting cash today. That will improve our liquidity. Also, we don't have a burden of collecting, following up with the customers and all. Yeah, so it's a benefit to us. And now, well, factoring can be without recourse, it can be with recourse. A factoring without recourse means factor bears the risk of uncollectibles. Your customers do not pay on time or they become defaulters. Factor bears the risk. Risk is transferred to the factor. So we do not have any obligation when the customer accounts become bad. Yeah. Risks and rewards are transferred to the factor. Of course, the factor may charge heavy amount for this. With recourse means, though we are selling receivables to a factor, but still the risk is with us. If our customers do not pay to the factor on time, we have to pay this amount, whatever the uncollectible, that should be paid. So just observe this table here. Who bears the customer default? Without recourse, of course, the factor. With recourse, the seller, our company. Seller reimburse the factor? Not at all, because we sold outright in the case of without recourse. But with recourse, yes, up to that estimate, how much amount is not collected by the factor. Recourse liability is recorded? No, because we ultimately transferred our receivables to a factor. So there's no question of bad debts in our books. Whereas with recourse, yes, we record to the extent of estimated amount as a liability, as a contingent liability. What about the factor fee? How much they charge? Yeah, higher, because in case of without recourse, as a factor is bearing the risk, he will charge you heavy amount. In case with recourse, it's a lower as compared to without recourse. Now let's see one question here. Brightstone Manufacturing Company has $500,000 of accounts receivable with 60 days credit terms. To fund payroll and inventory immediately, it sells these receivables to a financial institution after the transaction, that the institution collect the payments from customers. Here it is very clearly mentioned that $500,000 of accounts receivable is sold to a factor. Yeah, sells, it is given here clearly, sells means what? It is factoring. Factoring means sale of accounts receivable, not pledge, not assigning, not writing off. Yeah. Then the next question is, Aurora Corporation sells 750 sales. Huh? Aurora Corporation sells 750,000 accounts receivable to a factor without recourse. So the credit risk is transferred to the factor. The factor charges 2% factoring fee on gross receivables. Gross receivable means the total amount of receivables. How much you collect is net proceeds, but how much you are factoring is 750,000 here. So the fee what we pay is on 750,000, and also deduct 6% annual interest for 30 days because the payment is advanced immediately. Now use a 360-day year and ignore all other adjustments. So you'll have to be a little bit cautious about it here. 1, we are selling without recourse. So there's no question of bad debts in our books. Outright, we are selling outright. 1, there is a factoring fee that is on gross receivables, that is 750,000 times 2%, and 2, an interest amount, because this amount is going to be collected by factor after 30 days from now. And there is an interest rate of 6%. 6% per year, 360 days. But the accounts receivable is due for only 30 days. So what you need to do is you need to calculate 750,000 times 6% times 30 days divided by 360 days. So how the calculation goes? Calculation goes like this. 750,000 times 2%, 15,000. Interest amount 750,000 times 6% times 30 divided by 360, because the receivable was due for 30 days, 3,750. So now the factor, from 750,000 he will deduct 15,000 towards factoring fee, 3,750 towards interest amount for a period of 1 month. So what amount we'll get is 73,250. 731,250. 731,250 is the net proceed. Now with recourse, what do we understand about with recourse? Ultimately, if the factor is not able to recover this amount will come back to us. Yeah, whatever the amount the factor is not able to collect, we bear the risk. Seller remains responsible for customer's default. So we record this obligation in our books to the extent of estimated amount. To the extent of estimated amount, we record in our books. Take an example like receivable factored with recourse. With recourse, risk is still with the seller. The receivable amount factored is 600,000. The factoring fees is 3% on 600,000. 18,000 is a factoring fee. Cash advanced by the factor is 582,000. There will be an interest amount also. I'm not considering interest amount for this question. And say for example, there is an estimated amount of 12,000 doubtful debt. So record that estimated recourse obligation 12,000 you need to record as a liability. I did not calculate interest here. Interest should also be calculated. So how do you calculate the net amount received? Face value of receivables minus factoring fee, that is percentage on the gross receivables, minus interest, that is the percentage of interest on the face value of the receivables, times the days, how many days the receivable is due, divided by 360. That will you will receive. Sometimes factors may finance only 80% of the amount. They keep 20% as a margin money. So in that case, you will have to calculate on 80% amount financed. Yeah. Now this example gives you 1 million without recourse. Means what? Risk is transferred to the factor. with a 3% fee on gross receivables, 8% interest on 45 days balance outstanding. So calculate 3% fee on 1 million, 30,000. Calculate the 8% interest on 1 million for 45 days, and the calculation goes like this: 30,000 towards factor fee and 10,000 towards interest amount. The net amount what we received is 960,000. So net sale proceeds include 960,000. And remember, at any time in case of with recourse, if the factor is not ready to give you entire 1 million now, he may finance only 80%. 20% he will retain with him, and he says, after 45 days, when I collect from your customer, I will pay you that amount. In that case, you need to calculate interest on 800,000, not 1 million. Make sure that the factor is giving you full amount or only a portion of the receivables. You need to read the question carefully. This question: Meridian factors 600,000 of accounts receivable with recourse. So there is a liability. With recourse is there. Factor charges 3% fee, advances remaining amount immediately. Meridian estimates that the recourse obligation will be around 12,000. So what statement is correct? Which statement is correct? Meridian transfers all credit risk to the factor. Is it without recourse? No, it is with recourse. Meridian recognizes a recourse liability because it retains credit risk. Yes, it's a correct answer. The transaction cannot qualify as a sale. No, it is a factor. It is given there with recourse. Yeah. No accounting entry is required for the recourse obligation. What we studied, if it is with recourse, we have to record the obligation. It is mandatory. Yeah. So B is the correct answer. One more question. Zenith Incorporation factors 1 million of accounts receivable without recourse. The factor charges 3% factoring fee and 8% of annual interest for 45 days on the amount advanced. Assume 360 days a year, what amount is collected? Yes. Here it is without recourse. You are 100% financed because it is not given in the question that 80% is financed. You need to calculate interest on whole 1 million for a period of 45 days. So we already calculated this amount in the previous example. 1 million times 30%, 3%, 30,000. 1 million times 8% times 45 days divided by 360. Yeah. If the question says 365, you should take 365. Here it is 360. It will give you what? Yes, 960,000. Like this. Fees and interest calculation. Net proceeds received is 960,000. Okay, this is about factoring sale of receivables without recourse, with recourse. Remember, 2 deductions from your receivables, from the face value of receivables: fee and interest. Never just one of them. Sometimes interest may be calculated on the amount financed, not on the gross receivables. So you need to read the question carefully. Interest is always calculated for the duration, for the amount advanced, not per year. And remember, factoring is not pledging. Pledging is like giving your receivables as a collateral, not a pledging. Factoring is sale of receivables. Hope you understand our factoring in detail. Keep watching. We'll see you in the next session. Until then, have a good time.